Whenever you talk about good quality businesses with steady dividends, people mention Lowe's. It makes sense, right? Lowe's is a dividend king which has consistently outperformed the S&P over the last couple of decades. However, is Lowe's a buy now? Should we be looking to buy this dividend king or putting our money somewhere else? Let's take a look. Most of you know that Lowe's is a home improvement retailer based in the US. They sell all kinds of products for construction, maintenance, remodeling, DIY, appliances, power tools. It's a wide selection. Home improvement is part of the consumer discretionary sector, and that sector tends to be cyclical. It does really well when people have money to spend, and it behaves really badly when that is not the case. The last year hasn't been great for Lowe's, as the retailer is expected to see a 2.2% shrink in EPS for this fiscal year. However, we are seeing signs of reversal. Analysts have started ramping up their expectations for the next year, with 22 revisions up and only 5 revisions down. Currently, they are expecting to see an 8.6% increase in EPS, along with a small 1.55% increase in revenue for next year. I have to note that these expectations are based on the US economy accelerating over the next year. So if that's not the case, then it could be a good idea to avoid Lowe's. Now, one of the reasons why I like Lowe's is their profitability. Even though their net income and free cash flow are nothing spectacular on their own, they're actually relatively high for the sector. They also have consistently high return on total capital and return on total assets. Both of these are a few times above what's usual for this sector. However, you can see here that it says Lowe's return on equity is not available. Why is that? Well, it's because Lowe's currently has negative equity. That is actually one of the issues I have with the stock. What Lowe's did over the last few years was leverage massively, and I mean massively. The long-term debt jumped from $16.1 billion in January 2020 to $35.4 billion right now. That's 2.2 times higher in less than 4 years. What Lowe's did with a lot of this debt is buy back a ton of shares. Over the same period, total outstanding shares dropped 23.6% from 755 million to 577 million. Normally, I would be ecstatic about this sort of buybacks, but I'm not sure about this situation. The bad thing is that it puts on so much extra risk on the company. The good thing is that most of this debt was issued when the interest rates were still low. This could essentially be a bet on behalf of Lowe's management that interest rates will come back down in a couple of years. Another positive thing is that this allows Lowe's to keep increasing the dividend. The stock is a dividend king with 59 consecutive years of dividend increases, but unlike most of its peers, it continues the strong dividend growth. The growth rate is 20% compounded over the last 5 years, and that's amazing to see. Plus, the payout ratio is just 31%, and that's normal for Lowe's, with the current yield sitting at just 2.2%. Now, the expectations for dividend growth are pretty high, sitting at 16.7%, but I'm not sure if Lowe's can keep this up. A lot of the dividend increase was made possible only by the massive borrowing and stock buybacks. Lowe's can definitely keep increasing the dividend by 5-6% or so, but I doubt that we will see any increases over 10 or 15%. In fact, it will be a red flag to me if Lowe's keep increasing the dividend this much at the expense of the payout ratio or extra debt. I prefer sustainability over stupid and vain business decisions. In terms of price, Lowe's is trading at around $200, having recently hit $237. It doesn't really have that much momentum, as we can see here. In fact, if we look at the moving average ribbon, we can see that Lowe's is trading under the 10, 50, 100 and 200 day moving averages, which typically signals a bearish trend. Despite this, Wall Street analysts have good expectation for the stock. Most analysts rate Lowe's as a strong buy. 17 out of the 35 analysts that have covered the stock in the last 90 days say so. The target prices vary from $180 to $290, with the average consensus standing at $248.3, giving us a 22.5% upside on the current price. When I look at my personal valuation models, the price of Lowe's varies between $254 and $333.6, which gives us some margin of safety. The upside is pretty good too, between 25.2 and 64.5% in the best case scenario. Currently, Lowe's is also trading below the historical levels for metrics like forward price to earnings ratio and forward price to cash flow ratio. Price to sales is similar to the historical and the PEG ratio is actually a bit higher than normal, which could mean that the growth is slowing. Purely based off of that, it could mean that Loaves is either trading at a slight discount or at fair value. Now, all of this sounds really good, but there are some caveats. I think that all of these expectations and valuations are based on the US economy doing better. Plus, with all of the debt that Loaves has taken on, they really need to see interest rates going down in a year or so. If they remain high, Loaves can see its interest expenses rocketing up high, and that's gonna eat into the EPS. Another big problem for retailers like Loaves is the rate of theft. It is honestly shocking to see the statistics. In 2022, shrinkage in retail accounted for 112.1 billion in losses, up 20% from the previous year. That's billion, not a million. For reference, the GDP of Idaho was 109.5 billion in 2022. According to the last earnings call, shrinkage was in line with last year, so it doesn't seem to be getting worse right now. But Loaves has had to invest heavily into technologies to prevent theft. We should keep an eye on the situation, but it seems like it may have peaked at this point. In conclusion, Loaves is looking like a good dividend pick right now. It can give us capital gains, it can give us a steady, growing dividend. However, we need to be mindful of the risk involved. What do you think? Would you be buying Loaves right now or waiting for a better opportunity? Do you have a stock that you prefer over Loaves? Let me know in the comments below, and please leave a like if you enjoyed the video. Thanks for watching, and I'll see you again soon.